Hey folks, Dan Bird here on October 13th, Sunday. Mr. Zuber is not around today, so I'm going to do a solo session, and it's going to be a pretty quick one because I'm actually heading out for the week. So let me share my screen real quick. By the way, everything was fine for the hurricane. Thanks everyone for your kind wishes for those that sent me emails and didn't have any damage whatsoever and did not even lose power. So it was good. Anyway, let's jump into it. This is the website, breakpointtrading.net. For those that are interested, the newsletter is right here. I usually put it out on Saturdays. I'm going to be out of town next week, so I'm not sure when. It might take until Sunday to get it out next week. So if you don't get it on Saturday, that's the reason. But keep an eye on that. I am going to actually use the newsletter today to talk about some things. I added this one feature here. In addition to these quick charts, I added what the overall market looks like right now. And this is a proprietary indicator that I created that essentially, for those that are subscribers on the market bias matrix page, has a combination of the indexes, sectors, industry groups, intermarket relationships, commodities, metals, and currencies. And each one of these are on a short-term, medium-term, and long-term basis. And this defines what each of those mean. I did have somebody, I put this in the newsletter this week, these two over here. So this kind of shows you a week over week view of how these things change. And you can very quickly, just by looking at the colors, get a sense for where the market's heading. So you can see down here, we had lots of green, then we went to lots of red, then we went back to lots of green. That's these two lows right here. So all this green right here is when we rode the market up right through here. Now we're going sideways. So it's a combination. It's kind of a combination of yellows, reds, and greens right now. And the market's trying to break out a little bit. We'll talk about that in a minute. And then the short term, medium term, and long term down here. So you can see kind of where they cross. So that's how that works. Each one of these has a chart. So if you're interested, for instance, in I know these are a little bit blurry, but that's just because I have to do a screenshot in order to get this on here. But it shows you when these change because they're highlighted. So these change to bull on Friday. So small cap change from bear to bull, and transportation change from bear to bull. And if you want to look at the individual charts, so small cap is right here. You can see that the 5 went above the 21. So it's in a short-term uptrend right now, right there. And that just happened. So you'll see that as they happen. On the day that they happen, these get highlighted. And the next day they get unhighlighted and new ones get added. So you can see down here, gold miners just changed to bullish. If you want to look at gold miners, there's the chart. So right there, 5-day went above the 21. So it just changed to bullish. Anyway, what I do is I put a consolidation of all of this together right here. And I've just taken this top piece, the overall percentage, and put that on the home page now. So you can get a sense for what the market's looking like at any point in time. And you can tell if it's starting to take off or starting to roll over. Right now, we're just going sideways. So we'll see what happens. But that's what those are. If we look at the S&P, which is here, S&P just broke out and trying to move higher. We'll see if it can. It's very bullish. The whole market is very bullish right now. NASDAQ has not quite got to its new high, but it is breaking out of this resistance area right now. And it's pretty close to the new high. New high is right up here. So if it continues to go up next week, then it will break through that one next week. We'll see. On that point, on the portfolios page, I had a subscriber ask me this question. I have a kind of a trend following system, market timing strategy. It's based on the total market index. So if you want to look at the long-term weekly, it's been in a long-term bullish position since way back here. Actually, even before then, but it is still bullish all the way up. And Then if you look at the daily, you can get a closer in view. And you can see right here, same thing with the 5 crossing the 21 right here. So got a short-term bullish signal here in September, but it had a medium-term bullish signal since August back here. So you can use those to make your transitions if you don't catch the long-term signal, which was way back here. And it too, this is the total market. So total market means all of these things: the Dow, NASDAQ, S&P, Russell 2000, plus 3,800 other stocks. So it literally is the total market. And this then shows you on a daily view what it's looking like, and it's breaking out. So the whole market's still breaking out, and it's still very bullish. Everything is trending up. There is no reason to be selling right now, other than to just be wary. I'm going to show you give you some data about that in a second. But the question was, this just turned into a long strategy for the market timing strategy. So it turned into long. These are leveraged ETFs. So QLD is 2 times the Qs, or 2 times NASDAQ. TQQ is 2 times or 3 times the NASDAQ, and SSO is 2 times the S&P. So they just turn long. You can see that all of these, the early signal, short-term, medium-term, and long-term, are all bullish. So if you wanted to play the 3X, the triple, you can just click on this button right here, and you can see that it is, again, breaking out. It's kind of going sideways right here, but everything looks very bullish. So hopefully this will continue. If it doesn't, then we will set stops and we'll get out quickly. So we may take a small loss if that were to happen. But the goal is to get in on a long-term basis. And long-term doesn't happen very often. So if we look at the TQQ on a long-term, we can see that it happened all the way back here in 2023. So the goal would be to get in when the long-term gives a signal back here, and just use this to stay in the whole way. And actually, it's still a long-term signal. But you can't always get in right when that happens. Do you want to wait another 2 years or 3 years, or who knows, maybe 2 months before this crosses back? But then when it crosses back above again, it could be another year before that happens. Or if it's already happened way back here, then look for signals to jump in when there's a pullback. So that's what we try to do. Anyway, that's the question was, if you get in with a partial position, which is certainly always recommended, when should you add? And my answer to that will be based on the data that I'm going to present here in a minute. So we are in a period right now that could be fairly cautious, or should be fairly cautious. Right now, until the last week of October, is typically a bearish cycle, but we have been very bullish. We have bucked that trend. September usually is bearish. You see it came down from August to September, but since then we've just been going up. Normally in September it goes down until the 3rd week of October. This time it's going up until right now. So we've got 2 more weeks left till the 3rd week, and we'll see what happens. Next week is options expiration. So that usually is what I call opposite week. So if the market has been trending higher, then usually right around options expiration, right here, it will reverse and start to go lower. We'll see if that happens. The catalysts have been very positive. GDP came in good. Jobs number came in great. CPI came in a little hotter than expected, but still lower than the month before. So everything with the economy still looks very good. However, if we look at on the charts page, and this is something that is kind of giving a little advance notice. If we look at the unemployment claims right here, you can see how they've been dropping. There's green bars mostly all through here. This is why I said unemployment would go down last month, which it did. So it went from 4.3 to 4.2 to 4.1. So 2 months in a row, we've dropped, but you can see why. Unemployment claims have dropped for 2 months in a row. However, you can see what's happening now. So this first red bar, there was only 1 day that was part of September 30th. The rest of that was October. The next red bar, which is way up here, is actually as high as it was all the way back here. So almost as high as the highest point all year. That was last week. Because of the hurricanes, we likely will get more unemployment claims. So this will probably continue to tick higher for the rest of October. And when this gets reported, the unemployment rate gets reported in November, then I expect it not only to tick higher, it may go all the way back to 4.3 again. So that is going to spook people, I think. The Fed is going to be in a very tight spot. They're going to see CPI continuing to drop, but jobs, unemployment rate going up. This is the reason they dropped rates before, but CPI is continuing to come down. So will they stick with a quarter or go with 50? I think they'll stick with a quarter, frankly. But there's no reason why they should change. But this probably will spook some people. Inflation might tick higher as well. And that will be a double whammy. So if we look at the CPI number, and the reason why it went down slightly last week is there was a big one that dropped off. And you can actually see it right here. I'll actually move this over to the side, and you can see the 12-month window right there. So there's the one that dropped off last month right here. But look at the one that's coming up. So the one that gets reported in November is very small. And it likely will show inflation going back up again. So instead of right now, we're at 2.4. I haven't updated this yet, but we're at 2.4. Actually shows you right here, 2.41. By the way, when this said it was 2.5, the actual number over here was 2.59. I mean, I think that's 2.6, frankly, coming in right at forecast. But 2.59, for some reason, they just drop off the last decimal and just call it 2.5. So 2.4 is what it came in at this month. I think we're going to go back to 2.5 or 2.6, probably back to 2.6 next month. So we're going to have worse jobs and higher CPI. And I think next month, the market is not going to like it. So that's one of my data points. So keep that in mind. For the other data points, I'm going to go to the newsletter. And I talked about all of this in the newsletter. So if you want to read it in more detail, you can read it there. So here is financials. Yeah, financials, next 2 months, October, November, usually the best months for financials. This goes back all the way back 12 years, by the way. So for financials themselves, this is the seasonality for 12 years. October and November are two of the best months of the year for financials. And here's how it does versus the S&P. Same 12 years. They are the best months versus the S&P. So they outperform, financials outperform the S&P. Banks did really well last week. They're going to have more reporting this week. So I think it's probably going to, the financials will continue to go higher. All right, let me show you a couple of things here that caused me a little bit of concern because I want to give both sides of the data. And in the newsletter, there are links here. So if you want to understand negative divergences, just click on that. It will explain it. If you want to understand a bearish wedge pattern, just click on that and it will explain it. But this is a bearish wedge right here. So this is my first data point of why things might not turn out as well as expected or as most years. Most years, November starts the rally into the end of the year. But I just gave you two data points, which are the unemployment rate's going to go higher and inflation is going to go higher in November. We also have a Fed meeting and they're probably going to cut, so that will be a positive. But here's a bearish wedge. There's actually two bearish wedges. So here's one from this date right here, which is the beginning of August. And you can see I just basically connected the lows. So we have higher lows, 3 of them going up. And I connected the highs right here. So this is as of the beginning of August. But you could also take it back here to the middle of July and connect this high with this high, where we are right now. But I'll just stick with this one for now. And if we look at the rotation down here, now these are relative line. So that what that means is it's discretionary relative to staples. If the overall trend is declining, then the first one is underperforming the second one. If the trend is rising, which it actually was right through this period, then the first one is outperforming the second one. So during this little period here, discretionary was outperforming staples. However, from this point back here, or this point, we can look at where we started the bearish wedge, actually right from back here, in general, it's down and it's actually rolling over and going down again. The NASDAQ versus the S&P is trending down. The technology versus the S&P is trending down, and growth versus value, that really important one, is trending down as well. Even if you drew the line straight across right here, as this is moving up and this is going flat, that still is a negative divergence. So that's one data point, and this does not say, actually there's three in here. The bearish wedge, you've got the relative charts underperforming, and you have a slight negative divergence up here as well with the momentum indicators. So none of this means that the market is going to roll over and crash. It just means caution is advised. The next one is the PE ratio. So here's the S&P. You can see the S&P broke out here recently. We're at all-time highs again. Even as it's breaking out, the VIX is moving higher right here. The PE ratio is almost at 30. Normal is around 17 or 18 down here. 20 is okay. 25 is where it starts getting up into elevated territory. And it touched 25 here in last year, 23. So this is a weekly chart. And then it broke out and we're out almost at 30 right now. All right. But as the PE has been going up, earnings have not. They've been going up, but they haven't kept pace. So earnings have not broken out from this period right here. Even though if you look at the PE ratio from here to here, definitely has gone up, but earnings from here to here has not. So what that means is the price of PE has been accelerating. So that is concerning because, I mean, again, high PE ratios does not mean the market's going to crash. It just means caution is advised. Just something to watch. So here's a chart that I found showing the standard deviation for the PE, 10-year PE ratio. And you can see back here in the year 2000, way up here, 3 standard deviations away. In COVID, right there, 2 standard deviations away. 2008, bad actually, PE was right about there before the 2008 decline. But we're up here at very elevated areas again. This is a PE similar to what I just showed you. The next thing is the Buffett indicator. And I heard about this, so I went out and actually found it. And the Buffett indicator, just an interesting data point. So Warren Buffett, he just takes a simple math equation, takes the total the value of the total US stock market divides by GDP. If that comes out to 100%, then the market is fairly valued. If it's less than 100, then the market is undervalued, and you can see right now where it is. The current ratio is 209%. So definitely overvalued, strongly overvalued, in fact. Why does it matter? Especially the value of the US stock market in terms of the size of the US economy. If the stock market is growing much faster than the economy, then it may be in a bubble. All right, and here's the standard deviations for the Buffett indicator. And you can see here, COVID, this is actually the bear market of 22 right here. We are above that point right now. Here's 2000 back here, and here's 2008 right here. Slightly above normal, not quite to the first standard deviation, but this is second standard deviation up here. So another cause for concern. The next one is the risk on. These are basically just stocks versus bonds, investment grade corporate bonds versus treasuries, longer term treasuries. This is high yield corporate bonds versus shorter term treasuries. You can see risk on is where we're at. So in every situation here, if this is going up, that means more money is going into corporate bonds than treasuries, or high yield corporate bonds than short-term treasuries. So that means it's risk on. So the market right now is in a risk on phase. Everything's hitting new highs, even as growth underperforms value and discretionary underperforms staples. So one more data point. The VIX, here's what the VIX looks like. So the VIX, if you remember when it spiked higher back in July and the market rolled over, these are just the moving average lines of the VIX. The short moving average crossed the longer term right there, which is right in this area, just as it was hitting 17. So if it's below 17, the bulls are in control, and above 20, bears are in control. So this crossed right there. And we had a sell-off in July, and then it reversed pretty quickly. So what does it look like right now? Well, now we're not only above 20, but we're staying above 20. So we went above 20 for a couple of periods right here. This is a daily chart. So for about 4 days, we went above 20, but we've been above 20 for that same amount of time right now, and it's staying up there. So that's another point of control. It's at 20.16 right now. 16, I think. The other thing to look at is the 12-month rate of change of the VIX, and it is definitely moving higher. The moving average lines just crossed just last week. And this here is correlation of the S&P versus the VIX. So when correlation is high, when it's above 0, that means they are highly correlated. The VIX and the S&P are usually not correlated. They are inversely correlated. When the S&P goes up, the VIX goes down. When the VIX goes up, the S&P goes down. When they become correlated, which does not happen very often, that usually means there will be a trend change. So take all of this in combination. Again, I'm just presenting the evidence for you. You can make your own decisions of what you think might happen, but I'm just presenting the evidence. So the VIX right now is correlated with the S&P. That means they are both going up. The S&P is rising at the same time that the VIX is rising. It doesn't usually last very long, and it usually means a trend change is about to occur. All right, and then finally, here's a sentiment chart of the NASDAQ 100. So you can see there's the bearish wedge once again for the NASDAQ 100. I drew these vertical lines at the peaks. So these are the two recent peaks. Here's the one in July. Here's the one in August. Now these weren't huge pullbacks. So I'm not saying that there's going to be a crash. We could get a pullback similar to this. I'm just saying that all of these indicators are starting to line up. So if we follow this down, first of all, we'll look at the number of NASDAQ 100 stocks above the 50-day and above the 200-day. There are 77 of them above the 50-day, and there are 73 of them above the 200-day. So again, very, very bullish. The whole market is extremely bullish right now. If we look at the advanced decline lines and look at where these same peaks were. So remember, these are the peaks. This is the recent peak, but we're coming right back on and probably going to break through it potentially next week. But these are the recent peaks, and you can see the advanced decline line was going up. So there are more advancers as we hit the peak, more advancers as we hit the peak. Right now, there are actually decliners. If this is the peak, where there's actually decliners right now as we're moving up. And then the put call ratio indicates when this is going up, that means there are more people buying puts. So it's negative. You can see when it hits the bottom down here, it is counterintuitive. So when the market hit the peak right here, people continue to buy calls. So when it goes down, that means lots of calls being bought. People are positive on the market. When it goes up, that means lots of puts being called. So again, market hit the peak right here on this line, more calls being bought briefly. Market hit the recent peak right now. We could break out. So this line could get moved over, but look where the put call ratio is. Everyone is positive. Everybody is buying. So that is always a concern. And I actually put an excerpt from a newsletter that I get, which is actually really good and it's free. So Real Investment Advice, I put the link right in my newsletter. So this is an excerpt from them. This shows you the breakdown of the CPI. If you want to see, what they were, this is what I was saying before. They talked about CPI coming in at 2.6. It actually was 2.59. Oops. Let me go back. Where is my newsletter? There we go. So, but the important thing I wanted to show, there's 3 measures of inflation. You can see right now, the blue one is CPI core year over year. The black one is headline CPI, and the red one is CPI without housing and healthcare. Both of those are heading lower. I think these are going to tick back up next month. But here's the important thing. When everyone has bought, who is left to buy? Trick to navigating markets is not trying to time the market to sell exactly at the top. That is impossible. Successful long-term management is understanding when enough is enough and being willing to take profits and protect your gains. For many stocks currently, that is the situation we are in. Manage risk accordingly. So back to the question about, will the triple Qs continue to go higher? When should you add? I would say don't add at this point. They still could go higher, could go much higher. We don't know. But I just gave you all of the evidence of things that potentially are pointing to a possible pullback. Not necessarily a correction, certainly not a crash, but certainly a pullback. I think it might not be the historical trend that we normally see in November. So take this information for what it's worth. None of this means that we're going to go down, just information for you to consider. The final thing that I want to do, and this is just kind of a fun thing, is I found this list of the top 10 trading movies every trader should watch. Let me make this a little bigger. So I'm sure lots of you have already seen these. I've seen all but one. There's only one of these I haven't seen. I'm gonna have to check it out. So number 1, Wolf of Wall Street. It's a true story with Leonardo DiCaprio. Let's see if you probably have seen that one. Number 2, The Big Short. This is also a true story. Starring Steve Carell, Ryan Gosling, and Christian Bale. Subprime Home Loans of 2008. So there's quite a few 2008 related movies in here. Number 3 is Wall Street, back in 1987. Charlie Sheen and Michael Douglas. That's a classic. Even further back, 1983, was Dan Aykroyd and Eddie Murphy with Trading Places. That's another fun trading story. Rogue Trader, this is the one I haven't seen, so I have to see what this one's all about. Ewan McGregor. This also is about, this is interesting because illustrate one of the most common mistakes among traders, not cutting losses quickly. So this is a Forex trader. This is actually based on a true story too, about how he practically bankrupted one of the banks in the UK. Also a true story. Wall Street 2. Not as good as Wall Street 1, I don't think, but interesting anyway. Michael Douglas, Shia LaBeouf. Margin Call. This one is also about the 2008 financial crisis. This is a pretty good movie. Inside Job with Matt Damon. This is a look, again, at the 2008 financial crisis. And Barbarians at the Gate, about the true story about leveraged buyout of RJR Nabisco. This was actually a really interesting movie. And then Boiler Room, which is a eye-opening movie about pump and dump schemes, and it's a good reason why you shouldn't be buying penny stocks. Just watch this movie and that hopefully will cure you of buying penny stocks. So I hope you found that interesting. I'm sure there are other trading type movies out there. If you guys have seen one that's not on this top 10 list, I'll put the top 10 list in next week's newsletter actually. But if you've seen one that's not on the list, please put it in the comments below. I'd love to see it. I love watching these kind of movies. So I hope everyone has a great week and good luck trading. Take care.